So let's in this video talk a little bit about commodities and how people trade those. Sounds a bit exotic, doesn't it? Commodities. And let's just look at what that actually means. Well, for a start, commodities is of course anything like oil and gold and wheat. And how does this work? Well, first of all, they're traded on exchanges which are regulated, a bit like the stock exchange. So people trade through a central body, unlike foreign exchange, which just happens between banks and brokers in a mass market. The contracts with commodities tend to be standardized. What that means is you know what you're buying. You're buying a certain quantity and quality of the commodity. So you might be buying, for instance, things are priced in ounces of gold, and the gold is of a certain purity. Or you're buying a certain number of tons of wheat. And that means because the contracts are standardized, you can price things. Because, of course, if everything was of different quality and different quantity, you couldn't ever price it. So that's one aspect of how it works with things being standardized. They're traded as futures. What does that mean? Well, we don't need to worry about that too much. All we need to know is that we're buying one price and selling another. We're never going to take delivery of the actual gold or the oil or the wheat. So we're buying and selling contracts for future delivery. That's actually what we're buying and selling. That's what we're pricing. So we're rarely, when we're trading commodities, trading the actual product itself. We're trading the contract for delivery of it at some time in the future, hence it's futures. Most people trade commodities or own commodities as diversification to their overall portfolio. What is diversification? Well, imagine you only own stocks. Well, you therefore hold a risk to a stock market crash. If you hold stocks and commodities, it's been shown that you can have greater reward for the same level of risk and volatility in your portfolio. It's quite a complicated concept, but the simple way of looking at it is you're not putting all your eggs in one basket when you have commodities as well as stocks or as well as currencies and all these other products. It means that you're diversified away from risk, and you've got a greater chance over a period of time of getting more reward than if you only put all your money on just one product. Who are the people who are involved in this? Well, obviously there are traders. There are hedgers, people who might own a lot of gold and are saying, well, actually, I'm worried the price of gold may fall, so they'll short gold futures. That means they expect the price of gold to fall and therefore the contract futures value of gold to fall. So the amount of gold that they own or that drops in value, they'll be compensated or hedged by the fact that the value of the contract they have has fallen and they sold it at a high price, bought it back cheaper, and that's the profit difference. Remember, buy low, sell high is how we make money in the market. So similarly, sell high, buy low. Just doing it the opposite way, that's shorting. It still works. And these are the people who participate in the market as a whole. Okay, well, let's have a look at a particular commodity. In this case, we're going to look at gold. And people ask, well, wait a minute, isn't it complicated trading commodities? Like with foreign exchange, there's two different factors we have to look at. There's fundamentals, which are things which cause the price to move to do with the broader economy, like growth in world money supply and volatility of oil prices. All these factors affect gold prices, and you can see how we've drawn it here: credit crisis, low interest rates, and so on. What does this mean for us if we're trying to interpret gold and gold price movements? Well, it means we'd have to know a lot about the macroeconomy and then base our views on that. So I'm going to explain this as a strategy, but we're not going to use it because it's a little bit complicated to train everybody to be a specialist. But it's good to know that some people look at this. Instead, we're going to focus all our strategies on price charts, on charting, and my videos on advanced strategies apply as much here, and I'll talk a little bit more about strategies in a moment. But with gold, this is a basic chart of some of the factors which affect it when we look at fundamentals. As I say, I'm going to show you videos on looking at charts, and that's what I prefer doing and the platform on which I prefer doing it. But for now, this is to give you a broader understanding of what moves gold and gold prices. And you can see here, and I've taken a period, quite a long period from 71 to 2008, various factors which cause gold prices to move, Afghan invasion, inflation, and so on. And some of the things you might think, well, they seem odd to be related to gold. Why is that? And a lot of people don't actually want to be an analysis or somebody who analyzes these macro factors. What they actually prefer doing is following the price chart, so the technicals or charts as opposed to fundamentals, and that's what we're going to focus on. Remember, I said the contracts are standardized, so this was all in dollars per ounce of gold, and this is the price of gold, and the futures contracts would track that very closely indeed. So that is, in a way, one of the key commodities we're going to look at and examine for trading gold, because it's so popular. And that being the case, it's very good for us. And it's very good for us because it's a popular commodity. It's easy to trade. A lot of people do it. There's a lot of data and information. But like with foreign exchange and other products, we now need to know, how do we know when to buy? How do we know when to sell? And those trading strategies, we're not going to just simply use our analysis of the macroeconomy, because like I said, that can get quite complicated. We're going to use price charts. We're going to use what we call technicals. And so, that being the case, we will go through price charts and technicals in a moment in our videos. And you can see why gold is popular, of course, because when you get something which for quite a number of years has just been going in one direction, it's a pretty easy trade in which you can make money. And you can see where it's gone up more than 5-fold. It's gone up pretty much over 10-fold. You could just buy and hold it. Now, currencies don't tend to do that. Stocks tend not to do that unless they're .com or internet stocks. So that being the case, what is it about gold that makes it so attractive to people to trade? Well, first of all, that there's so much data, and the fact that it has been a one-way bet. But it all depends which time frame we look at. This is a chart where we're looking at each year. If we look at 5-minute charts, it wouldn't look like this. For 5-minute charts, it'll go up and down and so on. And so what I'm going to do is show you the strategies which people use in a separate video that people use for trading gold. And that'll give us an understanding of how we're going to get buy and sell signals, how I get buy and sell signals for gold, and also allow us on whichever trading platforms and software that I use to trade this and profit from it the way that so many people so often in the markets do, and it's what makes gold so popular.